nice to see you all today. Have you been having a good day? Yes, excellent. Well, hopefully in 10 minutes' time you'll have had an even better day. And by the end of the day, a superlative day. Hi, I'm Modwenna Rees-Mogg. I'm here because I write about, hang out with, and generally chat about angel investors. How many of you know about angel investing? About 20% of you. How many of you have done equity crowdfunding? How many of you have heard of Brewdog? Right, how many of you have heard of Innocent Drinks? Google. Yeah, Skype. Okay, Google, Skype, Innocent Drinks, Body Shop, all backed by angel investors. People I like to call millionaire makers, because they make millions for themselves, and when it goes right, they make millions for other people. So this is a little bit of information about them and what can happen in the life of being an angel, because I want you all, by the time we finish this talk, to be thinking about whether it might just suit you. And at the end, I'm actually going to give you the 10 habits of millionaire makers, to give you a starter for one. When I talk about angel investing, please also see that as similar to the topic of equity crowdfunding. There are lots of people here today. I think Naz is in the audience somewhere from Shadow Founder. Syndicate Room I know have been speaking today, and they do that sort of thing of basically investing in private company shares to try and make a superlative return. You want the superlative return because the risks are immensely high. 40 years ago, there was a guy running a garage in Brighton, and his girlfriend said, "My boss needs some money to open a second shop. Could you lend her some? Or could you invest something?" And he met this lady, and he decided to invest £25,000 in today's money. That was £4,000 back in 1977. About 25 years later, the company floated, and he took away 146 million. And that company was Body Shop. So that's what angels do when it works. But as an angel investor, your chances of having one of those ones is about 3 in 30. And you've got a more than 50% chance of actually never getting a penny back. But clearly, if you do it and do it right, you're absolutely laughing. And clearly, not only did Mr. McGlynn make himself an awful lot of money, he made the Roddick family even more. So it's not for everybody. You must be able to lose every penny you invest, because guess what? Lots of people do it and they never actually find their big return. But they usually have a lot of fun on the way, like any exciting high-risk investment opportunity. And there are very different types of investors. There are the small people who are doing, what I mean not small people, people investing small amounts, who do equity crowdfunding. I call them customer investors. How many of you have ever invested in something like a football club because you like it, or you're a fan? Has anyone ever done that? Yeah, one or two. And or maybe you buy shares in, traditionally people used to buy shares in cruise companies because they got a discount on going on their cruise, P&O for example. So those sorts of people are now appearing in the equity crowdfunding world and backing brands they love with maybe £10, £100, £1,000. That is a sort of angel investing, and it's jolly good fun. About 11,000 people a year are investing in that type of way in this country. There are about 500 to 600 to maybe 1,000 people who are investing up to £1 million a year. About 4 in 5 of them are men. They're getting younger, but as a rule they're older. I daren't say old. Some are working full-time, do it as a hobby. Other people do full-time angel investing. Some hunt in packs, and some fly what we call fly solo and do things very... I was once sitting innocently in a coffee shop in Fleet Street, minding my own business, and a little child in the middle of the day tipped orange juice during term time over my table by mistake, and the dad said, "Oh, I'm terribly sorry," and we mopped it up. And I said, "Well, so what are you doing with your children, you know, in the middle of the working week in the city?" He said, "Well, actually, I don't have a proper job. I'm an angel investor." So that's the sort of people you might meet. They are usually cool. They've usually made a lot of money, and they absolutely usually don't want to be constrained to a day job. And as I say, they back companies. Google was backed, Amazon, DHL, just name almost any major company in the UK, in America, they will have been backed by an angel when they very first started. Tax breaks really matter if you're an investor. This country has the world's best tax break offers for you investing in these companies, because the government believes that they should help you lot invest by giving you a tax break in order to help companies grow, because the adage is little companies create jobs, big companies fire people. So there are two major tax breaks you should pay attention to if you want to do this sort of investing. One is called the Seed EIS investment scheme. That's for the madly risky startup companies, which are less than 2 years old. But if you invest in them, you'll get 50% income tax break on what you invest. So if you invest £1,000, you then take your form to the taxman and say, I've invested £1,000, and they will send you back a cheque for £500. And you also get capital gains tax reliefs and all sorts of other things. And indeed, if that company goes bust, you will actually get more tax breaks under something called loss relief. So your actual cost of investment is very small indeed. EIS is the big brother tax break to SEIS, and there you get 30% income tax breaks. And you can use that for many companies which are fundraising, including many companies actually on AIM, the AIM market, will be EIS qualifying. So you'd be crazy if you're a UK income taxpayer not to use these tax breaks if you want to do this sort of investing. What are the things to think about if you're angel investing? It's really good fun. The entrepreneurs are great people. You see great ideas. You literally see the future, because you see the people who are starting businesses, and then guess what? 10 years later, they're enormous and everybody is shopping in the shop or buying the product. But the thing to remember is these deals are like buses. I absolutely promise you, however excited you get when you first look and you think, gosh, there's a lot of choice, I must get on with it. I promise you the next day there'll be just as much choice, and the next day, and the next day. So you don't need to be in any great hurry to invest tomorrow. Take your time to have a look at what's going on and get familiar with what you're doing before you invest. One of the reasons for that is because this is such high-risk investing, you have to sign certificates to say that you know what you're doing before you invest. And what that means is you will get no advice from anybody. There is no comeback. If you invest your money, it's you on your own investing your money. There's nobody you can blame if it all goes wrong. So do be careful if you're going to invest that you understand what you are doing. And the other really interesting thing about doing it is usually people who invest in 5, 10, 15 different deals. And what's absolutely true is where you'll get your amazing return is most likely going to be somewhere you absolutely do not expect it to come from. I was talking to an angel who's been a very serious full-time angel just this week. They've been investing full-time for 6 years. All the deals they made 6 years, 5 years, and 4 years, and 3 years. Nothing's come of it yet. They're still waiting. All the companies have gone bust. But one they invested in 2 years ago has suddenly sold for an absolute fortune. So they said, how can we possibly tell? So the message is definitely don't just invest in one. Make sure you spread your risk. So, I'm sorry, I'm just picking up my notes here. So, there are other things you need to think about. When an entrepreneur, has everyone seen Dragon's Den? I presume you have. So when these entrepreneurs who want your money, which I promise you they will if you stick your head above the parapet, they'll find a way to ask you for money. The typical thing they say is, we'll give you an exit by a trade sale or an IPO in 3 to 5 years. So when they say that, you then should do an internal translation in your head, which is, it probably won't IPO, it's most likely to trade sale, and it's going to take 10 to 17 years. So when you hear 3 to 5, just say, that actually means 10 to 17. That will help you out a lot, because you will not be surprised when you don't get your exit after 3 to 5 years. There's quite a lot of unexpected things. I think some people think that, angel investor, you just sort of stick your money and off you go. You'll find there's more paperwork than you expect, and the big one is the EIS scheme and SEIS schemes I talked about a bit earlier. They come with a physical piece of paper, and if you do not hand that physical piece of paper back to the taxman, you won't get your tax break. So that's the one bit of paper to really pay attention to, as well as, of course, any legal agreements. You should expect to be ignored, except when you're needed, or more importantly, your checkbook's needed. And you can expect to be very proud when it goes well, and slightly embarrassed and feeling foolish when it goes horribly wrong. I think it's great, it's fun, the entrepreneurs are great, angels are great, it's a lovely investment world to live in because people are so positive and creative and nice. And actually the research shows that, somewhat ironically for an investor show, angels do it because they want to have fun, change the world, give back, and then they want to make money as well. But money is not as important as you might think. Now, I think they say that because actually they know that it's so risky they don't want to put in any hope onto making money. But it is true that it is about more than just making money. It is about helping young people, helping create amazing drug discoveries or new medical devices that save lives, and many, many other things. I enjoy it, and I'm sure you would too. In terms of what I promised, the 10 habits of millionaire makers. So I don't know if you want to write this down or whether you can just listen hard and hopefully absorb. But these are the 10 habits of the people I see who make money out of this activity rather than losing it. 1 is they stay focused on investing in what they understand. 2, they invest rationally. And that's quite hard when you see things where you're having a lot of fun. So you think, oh, well, I invested in a chocolate company. If you don't understand chocolate companies and the chocolate industry, you really shouldn't invest in it. You probably will, by the way, but you shouldn't. You should invest in what you understand. You should stay focused in that area. Ideally, you'll find a buddy to invest with, where you have the same strategy and do things the same way, because 2 heads are always better than 1. It's very easy to be seduced by something exciting, and if you've got a good mate you trust, or a brother, or a sister, or a dad, or a son, who can give you another perspective, that will help you a lot. Getting good deals is actually less of a matter of chance. The fact that Mr. McGlynn backed Anita Roddick all those years ago was definitely probably more luck than judgment. Your best way to find the deals that are most likely to make you money is to network your way to good deal flow. That means find other investors, hang out with them, learn what they do, co-invest with them, and work your way through to finding really great deals. Don't imagine just because something looks shiny and glossy and it's suddenly landed on your desk that it's the best deal ever. When it comes to equity crowdfunding, what I say is follow your crowd when it comes to investing, not any old crowd. So just because something's crowdfunding really going brilliantly, go back to rule 1. If you don't understand it, however popular it is, don't invest in it, because it'll be a much more risky deal from your perspective. So we're up to number 6 now. For entrepreneurs, fundraising, I say, is like having crack cocaine. It's completely addictive for entrepreneurs. Once they've raised money and recognise they can do it, they tend to want to do it again and again. And you as the investor are the first port of call to get money those extra times. So that's not necessarily a bad thing, because companies sometimes need a lot of money to grow. But for you, what you should do is for every £1 you've invested in them, you should hold back at least £3 or £4 ready to invest again when they come back to you and ask for money. Number 7, calculate the average cost of the capital as you invest, because if you can imagine you buy shares at 25p when you first invest, and then the next round you pay 50p, and the next round you pay £2, your average cost is going to not be the original 25p, and that matters when you calculate your eventual return in all those years later. Always think about, which is number 8, always think about how you're going to sell your shares before you buy them. This is one of the biggest traps investors fall into. Actually think about it and say, I'm going to buy these shares, I may have to hold them for 10 or 15 years or maybe 2, but who's going to buy these shares off me? Because I think when you look at that, it will really impact on the decisions you make about investing. Number 9, spread your risk. Everyone should be saying that at this show. I'm sure they are. And my 10th and final one is join the slipstream of someone who's going to use your money to get themselves very, very rich. Angels get rich on the back of entrepreneurs who want to get very, very rich. If your entrepreneur who you're backing is not ambitious enough, it's very unlikely you will make a lot of money. You may have fun, but you won't make a lot of money. So that's all I have to say. Thank you very much indeed.